Hello, this is assignment 9.1 for data 620 by Michael Zerval, Professor Presentamento. With this presentation, we would like to compare equity returns for the United States versus emerging markets. The reason being is that we often hear in the media how a particular emerging market is experiencing rapid growth, but no one has ever talks about how to take advantage of this situation, nor gives us an accurate comparison. So the main question that we're trying to answer here, have foreign markets outperformed the United States? And if so, what future conclusions can we draw from that information? In order to do this analysis, we have selected 5 actively traded ETFs, which stand for exchange traded funds, and each ETF represents a basket of a particular country. So let's take a look at the returns. Here, the countries chosen were United States, China, Brazil, Mexico, and India. We can clearly see that the United States has been in an upward trajectory from 2009 up until 2019. The same cannot be said for other countries. We notice that Brazil is a little bit of a downtrend, same thing with Mexico. China is more or less range bound, and India has been flat but experiencing a little bit of a growth lately. So this chart indicates that if we were to invest money in the United States in 2009, we'd be a lot more happier in 2019. But let's take a look at this from a different perspective. Let's examine daily percentage variations. So what this chart indicates is how, on the average, how much a price of a security moves in a given day. And why this is important, it shows volatility. So we don't want to have a security that has great upward or downward swings because it can be bad for the heart. So we can see that United States daily prices average anywhere between 5 positive and 5 negative%. So not in a single day, in the majority of the day in the ranges of 2 and 3. So that means that every day the price moves up or down 2 or 3%. The same cannot be said for others, as we see more outlier moves in China right here. And Brazil, and here's a swing up to 10% and past 6 or 7. And Mexico also has a lot more outlier moves. Same thing with India. So we can state that day to day, United States not only has been growing more rapidly, it has less volatility. So let's take a look at the average annual returns. What strikes us here with this presentation is that we see that the United States have positive returns almost every single year. 2019 has not concluded yet, so we don't know what the result will be. And once again, the same thing can't be said for others. We see negative 4 years of growth here. We see a couple of negative growths in China, negative couple growths in Mexico, and a couple negative years for India. So all in all, it is clear that the United States stock market has outperformed all other major developing markets. Now that we're armed with this information, let's take a look at some forecasts. This is a 2-year forecast, and here we are the estimates are shown by these blue funnels, as well as a trend line. We see that Tableau is projecting US to be in a very narrow range, while others have a wide range, and some are downwards and some are flat. However, we do not believe that these forecasts are accurate, as the stock market is cyclical, meaning that after an up move, there tend to be a downward pressure. For that reason, we don't think that Tableau forecast is accurate, because once again, stocks don't go up forever. So let's take a look at one more chart, and this is a Bollinger Band forecast. This is a technical tool, and the Bollinger Band represents high and low points plotted against 2 standard deviations against a simple moving average. So in layman's terms, what that means is that once the price of security hits this lower band, like we see here, it tends to signal that it's a buy signal, and we see that the price have been going up. Same thing here, once it hits the lower band, the price eventually goes up. So the same thing can happen for the upper band. Once the price hits the upper band, we see a downward pressure. Here, the history repeats itself, and we see a much greater pressure. And once again, up to the lower band, signaling a buying opportunity. So our recommendation would be that at this point in time, as we're approaching the higher range, may not be the ideal time to buy, And if you have a position, maybe it's time to reduce exposure and wait for a better entry point in the future, as once again we stated that the markets are cyclical. I would like to thank you for your time, and all the ETFs used in this presentations are listed right here, and have a great day.